Okay, we are back with Chapter 11, your last chapter. Revision of Depreciation, Part D, page 4. Revision of depreciation due to changes in estimates or additions. You're going to read the additions in your text. You probably have done this in intro, so it's kind of a review. What's new though is changes in estimates. So I'm going to focus my examples on that, and you can just read that yourself. Okay. So under IFRS, you regularly review the asset's residual value, the estimated useful life, and the pattern in which asset benefits are received. When you revise an asset's useful life or residual value, well, let's stop there and let's think about it, okay? So I want to give you an example. So if you make an error, okay, let's say you're the new accountant at whatever job, and you were going to do the depreciation for this year, and you look back at last year's, and you notice they were using a useful life for computers, all your computers, of 20 years. Okay, so you think, okay, well, maybe it was just a mistake. You go further back, yeah, it's 20 years, and it's unlikely these computers are going to last 20 years. So you realize way back, or someone tells you, oh yeah, because that's how long they were doing all our assets, 20 years. Okay, so it's clearly an error. So you've just bought a bunch of new computers a couple of years ago, and again, they were amortized for 20 years. So, is that error or a change in estimate? It's clearly an error, okay? Now, changing an estimate would be, oh no, you bought a photocopier, you didn't lease it, you bought it. And you estimate would last, I don't know, 1,000,000 pages. That they're actually lasting much longer than that. Something, and so you change it from 1,000,000 pages to 1.5 million pages. Is that an error or a change in estimate? That's a change in estimate. When you make a decision using all the information you have and you make a good decision, there's nothing wrong with that. However, in the future, it might change when you're dealing with estimate life or residual value. So changes in estimates are different than errors. Errors are adjusted retrospectively or retroactively in retained earnings. And when we did the chapter, maybe chapter 5, on statement of retained earnings, and we showed corrections of errors, that's what we were talking about. Someone made an error, you go back and you fix it, but you don't go back and do the last 10 financial statements, 10 years. No, you just adjust it in retained earnings. Okay? And again, you'll do more of that 16. Now, when you revise something, so you have a change in estimate, it's not an error, so you adjust it prospectively. So that means going forward. So the calculations are adjusted from the point of the revision forward. Now, when a revision, addition, or betterment, now these two are of your little T account of a truck. Okay? How much do you want your truck to be? 100,000? Let's say it was. I have no idea how much a truck costs. Okay, 100,000. Now I forgot what I was saying. Hang on. This is my last chapter. You can put up with this just a little longer. 100,000. Oh, I know. Let's say you do an oil change. Is an oil change going to add to the value of the truck and make it more efficient and bring it more than when it was new, or at least the very same? No, it's not. So an oil change would be expensed. But what if you overhauled the engine? So you took it out, fixed it all up, maybe got new parts. Again, I don't know how to overhaul an engine. And you put it back in. Yeah, all of the truck is running as good as new. So in that case, you would add the overhaul, and then you depreciate it. That is a betterment. The overhaul is a betterment. Okay? An addition would be, let's say you had, and you added, you know, those little capsules for the back. That would be added on there. Okay, unless you had a whole fleet and you were adding it on all of them and it had a different life than the truck, then it would be componentized and be in its own little T account. Okay, but the overhaul would go in there because it's a betterment. If you had a building and you added another floor, it would be an addition. Maybe not another floor. Let's add a wing, because I don't know how easy it is to add a floor to a high-rise. Probably wouldn't add it in the middle. Okay, sorry, I'm getting a little punchy here. It's near the end of the term. Okay, so that's betterment, overhaul. An addition. Addition, betterment. So additions and betterments work the same way. They're adjusted prospective. And when we're doing the example, I'll show you what you do for those, just to remind you. Okay, so first, you calculate the depreciation to the point of the betterment, addition, or revision. Then calculate, you have to recalculate depreciation, so that's number 2, based on the new beginning carrying value, if we've had a betterment or an addition, a new life or residual, if applicable, and years remaining. Remember to keep assets componentized if necessary. So actually with a truck, you could have had an engine having a, and again, if you just have one truck, you probably wouldn't do that. If you've got a whole fleet, you might. So let's go through the example and try and make sense of this, since I got us a little off track there. So, machinery purchased for $49,400 by Indigo Corp, January 1st, 2015, originally estimated to have an 8-year useful life with a residual value of $3,000. Depreciation has been entered for 5 years on this basis. In 2020, they went, you know, estimated useful life, including 2020, really should have been 10 years. So the total should have been 10 instead of 8. Not an error. We're going to be using it for longer. And it should have a higher residual value. It's not wearing out as fast as we thought. So assumes depreciation, and we are using IFRS. So just before we go on, we need to go back to way back to page. So let's just go to page 2. Know what we're doing. Okay, so we're using straight line. I uses residual value, and this would actually apply for double declining also, not just straight line. IFRS uses residual value and useful life. So it doesn't use salvage value and expected life, or assets life. So let's see what we're given. We're given useful life or residual value, so we're good. Sometimes they will give you useful life, asset life, residual value, salvage value. You got to figure out what to use. So keep that handy, and let's go to the next page. Okay. So prepare the entry that's required to correct the per year's depreciation, if any. Well, when you have to correct something, that means there's an error. Was there an error in the change in estimated useful life? No. So there's no entry. it is a revision of an estimate. So it is adjusted prospectively. So going forward. Okay? So if it was an error, it's retrospective. Okay, now prepare the entry to record depreciation for 2020. Well, looking at our steps on the last page, the first thing we have to do is calculate depreciation to the oh my gosh, why do I think that? Depreciation to the point of the addition, betterment, or estimation. So, calculate depreciation to, what year was this? January 1st, 2020 to 2020. So, it's straight line, so depreciation expense equals cost, 49,400, minus residual, 3,000, divided by 8 years is 5,800. And how many years have passed? They've done it for 5 years. So times 5. So 15, 16, 17, 18, 19. So we're in 2020. So 5,800 times 5 is 29,000. So now, at the end of 2020, with change in estimate made during the year, and we can assume January 1st if it doesn't say anything specific. We have to calculate the new depreciation. Sorry, I'm going to use another color now. Calculate new depreciation expense. So you're going to take the book value, change, addition, betterment, or revision in estimate, minus revised residual, and sometimes it's not revised and just use the same, and life remaining is on the bottom. Okay, so our book value at time of change, book value is cost minus accumulated depreciation. So this is our accumulated depreciation. We take our cost, it hasn't changed, minus 29,000 value, and our new residual is 4,000. Everybody okay with that? So sometimes this changes, sometimes it doesn't. If you had, let's say, added on, what did we buy? Machinery. You added on another part to it, okay? Betterments or additions would be added here. You do the exact same steps. You calculate depreciation, then you go, oh, on January 1st, we added a new part for 1,000 or 10,000. So we'd add 49,400 plus 10,000 minus 29. Okay? So you did things like that in intro. Hopefully that'll come back. Okay, so we said in total there should be 10 years, right? How many years have gone by already? 5. So this is going to equal 3280 per year. So we debit depreciation expense, or I should in here, 3280 and credit accumulated depreciation 3280. Now, if it would have specifically said on April 1st,